GameStop was a dying mall video game store. Its stock price was $4. Professional hedge funds had bet billions that it would go to zero. They were almost certainly right. Then a message board full of amateur investors decided to disagree. What followed was the most chaotic week in stock market history, and the first time ordinary people broke a $1 billion hedge fund from their phones. Let's rewind. GameStop is exactly what it sounds like. A store in a mall that sells video games. Disc-based video games, physical cartridges, used games, gaming accessories. The kind of store that made sense in 2005 when you had to buy a game in a box from a shelf. By 2020, the business model was dying. Gaming had gone digital. PlayStation and Xbox sold games as downloads. Steam dominated PC gaming. You didn't need to drive to a mall to buy a video game anymore. You pressed a button on your couch. GameStop's revenues had been falling for years. Stores were closing by the hundreds. The company had tried to sell itself, but no buyers appeared. It kept opening stores it couldn't afford and shrinking everywhere else. The stock price in the summer of 2020 was about $4 per share. Into this picture walked Wall Street. When professional investors believe a company is going to keep declining, they can bet against it. This is called short selling. You borrow shares from a broker. You sell them immediately at the current price. You wait for the stock to fall. Then you buy them back at the lower price. You return the borrowed shares. You keep the difference. Short selling is legal, common, and often correct. When a company genuinely is declining, shorting it is simply accurate analysis. Melvin Capital was a $12.5 billion hedge fund run by Gabe Plotkin. It had shorted GameStop aggressively. So had other hedge funds. By late 2020, more than 140% of GameStop's available shares had been sold short, a remarkable number, meaning short sellers had borrowed and reborrowed the same shares, creating a precarious pile of bets stacked on the same deteriorating foundation. The hedge funds were almost certainly right. GameStop was dying. The bet was obvious. Then someone on Reddit looked at the short interest number and saw something else entirely. WallStreetBets is a Reddit community built around aggressive stock trading. In early 2020, a user named DeepFuckingValue, a financial analyst named Keith Gill in real life, began posting detailed analysis of GameStop. His argument was specific and patient. GameStop was oversold, had new leadership, still generated cash, and was being short-sold into oblivion beyond what the underlying fundamentals justified. More importantly, Gill noticed the short interest number, over 100% of available shares shorted. When a stock is massively short-sold, any sustained rise in its price creates a problem for the shorts. They have borrowed shares and sold them. If the price rises, they are losing money in real time. At some point, they must buy shares to close their positions, which requires them to buy the stock at whatever the current price is. But their buying drives the price higher, which makes the next short seller's losses worse, which makes them buy faster. A self-reinforcing loop. A short squeeze. All it required was enough buyers to start the fire. WallStreetBets started buying. Slowly at first, a few thousand retail investors accumulating shares and cheap call options. Then faster. Then the community grew from 2 million members to 8 million members in a week. Every post, every meme, every screenshot of gains brought new buyers. The price climbed. The squeeze began. By January 22nd, GameStop's stock had risen from $17 to $65 in 1 week. January 25th, 2021. GameStop is at $76. The short sellers are in trouble. Melvin Capital's losses are accelerating. Every dollar the stock climbs costs them more. They need to either hold their position and weather the storm, or buy shares to close, which makes the storm worse. On January 26th, Elon Musk tweets a single word, GameStunk, with a link to WallStreetBets. January 27th. GameStop trades as high as $483 per share in intraday trading. A stock that was at $4 in August is now at nearly $500. Melvin Capital is losing billions. The hedge fund receives an emergency bailout, $2.75 billion injected by Citadel Securities and $0.72 to keep it alive. And then the most controversial moment in the entire story. January 28th. Robinhood, the commission-free trading app used by most of the retail investors in the squeeze, restricts buying of GameStop stock. You could sell GameStop. You could not buy it. The restriction was applied to dozens of other meme stocks as well. The price crashed from $483 to around $193 that day. Robinhood's explanation: regulatory capital requirements. The clearinghouse that processes trades, the DTCC, had required Robinhood to deposit nearly $3 billion in additional collateral given the volatility. Robinhood didn't have it. Restricting buying was the only way to reduce the capital requirement. The Internet's explanation: Robinhood was protecting the hedge funds. Citadel Securities, which processes Robinhood's trades and is connected to the same Citadel that bailed out Melvin, was in the middle of all of it. The timing looked terrible. The optics were catastrophic. Whether the conspiracy theory was true or not, the damage was done. The retail investors who had held through $400 now watched the floor disappear. Not because the market moved, because the buy button disappeared. Congress called hearings. In February 2021, Gabe Plotkin of Melvin Capital testified via video call. Vlad Tenev, Robinhood's CEO, testified. And Keith Gill, deep fucking value, Roaring Kitty, showed up in person wearing a red headband and a cat shirt, and testified before the United States Congress that he was simply a guy who did his homework and believed in the stock. He was not an army general. He was not a hedge fund. He was a guy with a laptop who posted on Reddit. Melvin Capital did not recover. The fund lost 53% in January 2021. It lost more money throughout 2021 and 2022. In May 2022, 16 months after the squeeze, Gabe Plotkin announced he was closing Melvin Capital and returning remaining funds to investors. One of the most prominent short-selling hedge funds in America was gone. GameStop itself, the company used the attention to raise capital. It sold new shares while its price was elevated, raising hundreds of millions of dollars. Ryan Cohen became chairman and began restructuring the company. GameStop hired tech talent, cut stores, and attempted to pivot toward e-commerce and NFTs. The NFT pivot failed, but GameStop still exists, which was not guaranteed before January 2021. The squeeze did not fix GameStop. It did not fix wealth inequality. It did not fundamentally change how Wall Street works. Congress held hearings and passed no meaningful legislation. The hedge funds adapted. Robinhood had its IPO. But for 1 week in January 2021, a group of strangers on a message board held a position that cost them real money, refused to sell, and drove a $12 billion hedge fund into the ground. They called it holding the line. They called it diamond hands. They called it a movement. Whatever it was, it worked. Once.